How's it going? Do you ever get that feeling that you're just reacting to the market, always one step behind? Aye, we've all been there. Well, today we're going to flip that right on its head. What if I told you the market itself might be following a script, an annual cycle, and you can learn to read it? Welcome to AI Explains ICT. Now, this video is a proper deep dive. We're getting into the core content, month 5, episode 11 to be exact. So I'm serious now. Grab a pen and paper. You're going to want to take notes on this one. Trust me.
So let's just get right to the heart of it. What if you knew the market's most likely moves months, even months in advance? I mean, what if you had a kind of roadmap, right? Showing you where things were probably headed. It sounds a bit like a superpower, doesn't it? Well, it's not, but it is a massive, massive edge.
Right, so here's how we're going to break it down. First, we'll look at the market's secret map. Then, we'll decode its seasonal tendencies. We'll talk about how bearish moves can actually set up bullish opportunities. Then, we'll put the map to work with some real examples, and we'll finish up by talking about confluence. Sound good? Let's go? Okay, first up, the market's secret map. Now, before you start thinking this is some kind of crystal ball stuff, it's not. This is about using cold, hard data from years and years of market action to see what it likes to do and when. And the market we're going to be looking at today is the New Zealand dollar, or as you probably know it, the Kiwi. By zeroing in on just this one currency, ICT shows us how we can build a really detailed roadmap for its whole year. And we're not talking about scalp trades here, no, we're hunting for those big, juicy, multi-hundred pip swings. So we have this idea of a map, right? But how do we read it? Well, that's what this next part is all about, decoding seasonal tendencies. This is the key to unlocking the whole thing. So, what is a seasonal tendency? Honestly, it's pretty much what it says on the tin. It's a pattern, a habit that a market tends to follow at a certain time of the year. Think of it like the seasons. It's not just random guesswork. It's based on looking back at years, sometimes decades of data to spot these recurring moves. And here we have it. This chart, this is the map we've been going on about. You see the two lines? The blue one is based on 19 years of data, and the red one is 15 years. Now here's the magic bit. When you see both of those lines moving in the same direction together, that's when you found a really high probability tendency. That's the signal you're looking for. Right, let's zoom in a wee bit. See this area here, from mid-February to mid-March. Look at that. Both lines, the 19-year and the 15-year, are pointing down. They're both agreeing that the Kiwi has a strong habit of dropping during this time. That's our first big bearish marker for the year. Okay, let's keep going. What happens next? Well, the map shows us that the Kiwi often pushes up to a peak around May. And then, what happens? Bang. Another big sell-off, a really reliable one that can carry on right into June or July. So that's the second bearish window we need to have circled on our calendar. But it's not all doom and gloom. Let's look at the other side of the coin. After things get a bit messy in the late summer, have a look at what happens between September and October. See that? The chart shows a really strong tendency for the Kiwi to bottom out, to form a major seasonal low. And what does that set up? A big, powerful rally right into the end of the year. Beautiful. So we've got these bearish times of year, right? But here's where ICT's genius really kicks in. It's not just about seeing the drops. This brings us to the real meat of this video. Bearish moves, bullish opportunities. Now just think about this for a second. What if those drops we saw, the ones in Feb and May, what if they aren't just a signal to sell? What if their real job is to engineer the perfect setup for the best buying opportunity of the quarter? And that, my friends, is the big idea. The whole strategy is to see these bearish periods coming, not just so you can short them, but so you can get ready. You use them to position yourself for the huge bullish runs that tend to follow. This is what ICT calls a quarterly shift, a massive turn in the market that can give you a trend for months. Okay, it sounds great in theory, but does it actually work in the real world? Well, let's see. Section 4, putting the map to work. We're going to look at some real charts now. Check this out. This is 2011. On the left, you've got our seasonal map telling us to expect a dip between February and March. And on the right, that's the actual chart from 2011. And look at that. It's like it read the script. Price drops right into that window, finds a low, and then just takes off like a rocket. A massive rally. And it wasn't a one-off. Let's look at the very next year, 2012. Remember that sell-off we expected in May? Well, in 2012, it was an absolute monster. We're talking nearly an 800 pip drop. And where did it stop? Right in June, right where the seasonal map told us to look for a low. And just like the year before, that became the launchpad for another incredible rally. Now listen up, because this is probably the most important thing I'll say. This is a tendency. It is not a certainty. You have to understand that. A massive global event, something like the 2008 financial crisis, that can come along and just rip up the script completely. So remember, this is a roadmap of probabilities, not a crystal ball for prophecies. So, with that in mind, how do we use this map properly? How do we use it to our advantage? Well, that brings us to our last section, trading with confluence. This is where we tie it all together. Right, let's make this simple. Here's your annual cheat sheet for the Kiwi. Get your pens out. The bullish times we're looking for are generally March, April, June, July, and September, October. The bearish times, where we expect price to drop, are February, March, May, and around mid-August. This is your bird's eye view for the whole year. And this quote from the man himself, ICT, just sums it up perfectly. They're not panaceas. They're roadmaps as to what price has done in the past historically. See, it's not a magic bullet. It's a map. It tells you where the treasure might be buried, but you still have to go and dig for it yourself. And that brings us to the final golden rule, confluence. That's the key. You never, ever trade just because the seasonal map says so. No. You wait for the map team to line up with everything else in your toolbox, your market structure analysis, your order blocks, your liquidity concepts. When the map, the time of year, and your own analysis all sing the same song, that is when you have a high probability setup. That's the A-plus trade. So there you have it. I really hope you enjoyed that wee breakdown. If you found it helpful, do me a favor and hit that like button. And of course, subscribe to the channel so you don't miss the next one. And listen, if you have any questions at all, just pop them in the comments below. A real human will get back to you, I promise.
All right, that's all for now. Safe trading.